Imagine someone hands you a suitcase filled with millions of dollars. The money is real. The bills are real. But there is one problem. The money has a history, and that history is dangerous, because somewhere in the past, that cash may have come from fraud, corruption, illegal gambling, drug trafficking, cybercrime, or some other criminal enterprise. Now, the person holding it has a problem. They can't simply walk into a bank and explain where it came from. They can't spend millions of dollars without raising questions, and they can't easily move it across borders without leaving a trail. So what happens next? The money enters a completely different world, a world of companies that barely exist, properties bought and sold between connected parties, international transactions, complex financial structures, digital assets, and sometimes institutions that fail to notice what is happening right in front of them. This is the world of money laundering. And contrary to what movies often suggest, laundering isn't one single trick. It's a process designed to slowly separate money from its original criminal source until the connection becomes difficult to see. But here's the part that makes the entire system fascinating. The same financial system criminals try to exploit is also the system investigators use to find them. Every bank transfer creates a record. Every company leaves paperwork. Every property has a history. Every cryptocurrency transaction leaves data on a blockchain. And eventually, all those pieces can come together. This is how the hidden journey of dirty money begins. Stage 1. The money enters the financial system. The first challenge is always the same. How do you move suspicious money into the legitimate economy? This stage is often called placement. It's the moment when illegally obtained funds first attempt to enter the financial system. For someone dealing with small amounts, the problem might seem simple. But as the amount increases, the risk increases with it. Banks have reporting obligations. Financial institutions monitor unusual transactions. Large cash movements can trigger automatic reviews, and suspicious behavior doesn't have to involve one giant transaction. Patterns matter. A series of unusual deposits, multiple accounts receiving similar payments, transactions that don't match someone's known income, businesses reporting revenue that doesn't make sense compared with their size. These patterns can attract attention even when individual transactions appear ordinary. This is one of the biggest misconceptions about financial crime. People often imagine investigators searching for one obvious transaction, but modern financial investigations rarely work that way. Instead, they look for relationships. Who sent the money? Who received it? What accounts were involved? What companies were connected? Where did the money go next? The transaction itself may look harmless. The network around it may not. And that's where financial intelligence becomes powerful. Stage 2. The business that looks completely normal. Now imagine a business that legitimately handles a large number of transactions. A restaurant, a construction company, a retail operation, a car dealership. Any business with complicated revenue streams can potentially create challenges for investigators because real businesses already produce thousands of legitimate transactions. This creates something criminals value: noise. When legitimate transactions and suspicious transactions are mixed together, separating the two becomes more difficult. But there is an important difference between looking complicated and actually being legitimate. Real businesses have customers. They have employees. They purchase supplies. They pay taxes. They have utility bills. They have inventory. They have economic activity that leaves a footprint. Investigators can compare these different pieces. If a company reports enormous revenue but has almost no employees, very little inventory, and almost no operational activity, questions begin to appear. The numbers may look impressive, but the business behind those numbers may not exist in the way the paperwork suggests. And that's when investigators start looking beyond the bank account. They start looking at the entire company. Stage 3. The paper company. This is where the world of financial crime becomes much more complicated. A company can exist legally on paper, without conducting much real business. These entities can have names, registration documents, bank accounts, directors, addresses, and accountants. From the outside, everything may appear legitimate, but the real question is simple. Who actually controls the company? This is known as beneficial ownership. The person whose name appears on a document isn't always the person ultimately controlling the money. That distinction is extremely important because financial investigators aren't just interested in companies. They're interested in the people behind them. A company might appear unrelated to another business, but perhaps both use the same address, the same accountant, the same legal representative, or the same individuals quietly controlling decisions behind the scenes. One connection may mean nothing. 5 connections may be coincidence, but dozens of connections can reveal an entire network. This is why modern investigations increasingly focus on relationships rather than isolated transactions. The money doesn't have to announce where it came from. The network around the money often does. Stage 4. The real estate connection. Real estate has long attracted attention from financial crime investigators, and the reason is obvious. Property transactions can involve enormous amounts of money. A single building can be worth millions. A luxury apartment can change ownership several times, and property values can be difficult to determine with absolute precision. That complexity creates opportunities for abuse, but it also creates evidence. Every property has a history. Who purchased it? Who financed it? Who sold it? Who owned the company that bought it? Was the property actually occupied? Was it rented? Was it renovated? Was the price consistent with the local market? Investigators can ask all of these questions. Consider a simple example. A property is purchased by a company. The company is owned by another company. That company is controlled through a trust, and the trust is managed by a professional service provider. On paper, the structure may look complicated, but investigators don't stop at the first layer. They keep going. Eventually, they want to know one thing. Who is the real person benefiting from this property? This is why beneficial ownership transparency has become such an important part of modern financial regulation, because hiding behind layers of legal entities becomes much harder when authorities can identify the individual at the center. Stage 5. The international money trail. Now the money crosses a border, and suddenly the investigation becomes much more complicated. Different countries have different laws. Different banks have different compliance systems. Different governments have different levels of cooperation. A transaction that begins in one country may pass through several financial institutions before reaching its final destination. Every step creates another layer, and this is where international cooperation becomes critical. Financial intelligence units share information. Law enforcement agencies cooperate. Banks communicate through regulatory channels, and governments exchange financial data under international agreements. But the system is far from perfect. Investigators may need records from multiple countries. Some information can take months or years to obtain. Legal procedures differ from one jurisdiction to another, and criminals constantly search for weak points in the global system. But there is one thing they can't completely escape: time. The longer money moves through the financial system, the more records it creates. And the more records exist, the more opportunities investigators have to find connections. Stage 6. Trade and the global economy. Now imagine 2 companies. One operates in country A, the other operates in country B. They appear to be independent businesses. They buy and sell products across international borders. On the surface, this looks like normal global commerce. And most international trade is exactly that: legitimate, necessary, and essential to the global economy. But international trade can also create enormous amounts of paperwork: invoices, shipping documents, customs declarations, insurance records, bank payments, and contracts. The sheer volume of information makes verification difficult. Investigators may have to compare what a company claims it shipped with what customs records show. They may compare declared prices with market prices. They may examine whether the business actually operates at the scale its financial statements suggest. A company claiming to move millions of dollars in products should normally have a business capable of supporting that activity. If the numbers don't match reality, the inconsistencies become clues, and modern technology is making these comparisons faster. Data analytics can identify unusual patterns across thousands of transactions. One suspicious shipment might be nothing. A repeated pattern over several years is something else entirely. Stage 7, the digital money era. Then came cryptocurrency, and for a while, many people believed digital assets would completely transform financial crime. The reality is more complicated. Cryptocurrency offers unique challenges, but it also offers something investigators love: data. A blockchain can record transactions permanently. Depending on the cryptocurrency, those transactions may be visible to anyone. The names behind the wallet addresses may not be immediately obvious, but the movement of funds can still be analyzed. Investigators can examine transaction timing, wallet relationships, movement between addresses, transfers to exchanges, and connections with known services. Specialized blockchain analytics companies have developed tools designed specifically to map these networks. The result is a strange contradiction. Cryptocurrency can provide a degree of pseudonymity, but the underlying transaction history can remain permanently recorded. That means a transaction that seems impossible to understand today may become much easier to analyze tomorrow. Technology changes, investigative techniques improve, and information that once appeared meaningless can suddenly become evidence. This is why the idea that cryptocurrency automatically means anonymity is misleading. In reality, digital money has created an entirely new battlefield between financial criminals and investigators. Stage 8, when the banks fail. The biggest financial scandals aren't always caused by criminals finding a secret loophole. Sometimes the system simply fails. Banks process enormous numbers of transactions every day. Their compliance departments use automated monitoring systems to identify unusual activity. But no system is perfect. An alert may be ignored. A customer may be incorrectly classified as low risk. A suspicious relationship may be overlooked, or thousands of individual transactions may appear harmless when viewed separately. The problem is that financial crime can hide inside complexity. A bank employee may see one transaction, another employee may see another. A compliance team may see an alert, but nobody sees the complete picture. This is why major financial investigations can take years. The evidence isn't always missing. Sometimes it's scattered across thousands of documents and millions of transactions. The challenge is connecting it. And when investigators finally do, the story can become much larger than anyone expected. Stage 9. The human who changes everything. Technology can find patterns. Algorithms can identify anomalies. Banks can flag suspicious transactions. But some of the biggest investigations in history began with something much simpler. A person, an employee, an accountant, a banker, a lawyer, a business partner, someone who noticed something that didn't feel right. Perhaps the numbers didn't match. Perhaps a company was receiving money from an unexplained source. Perhaps an executive gave instructions that raised questions. Or perhaps someone finally decided they could no longer stay silent. Whistleblowers can become extremely important in financial crime investigations because they provide something databases cannot always provide: context. They know how the organization works. They know who makes decisions. They understand which transactions are normal and which ones aren't. A single person can sometimes reveal connections that investigators might otherwise spend years trying to reconstruct. And that's why every sophisticated financial crime network has the same fundamental weakness: people. The system depends on trust, and trust can break. Stage 10. When the money trail comes back to life. Now we reach the final stage. The moment investigators connect the dots: a suspicious bank account, a company with no obvious business activity, a property owned through multiple entities, an international transfer, a cryptocurrency wallet, a financial institution, and finally, a real person. At first, these may look like unrelated pieces, but financial investigations are often built around one question. What happens when we connect them? Imagine investigators discovering that 5 companies share the same address. Then they discover that all 5 companies use the same accountant. Then they discover that the accountant's firm is connected to a trust. That trust controls a company that owns a property. The property was purchased using funds transferred from another country, and the money originally came from an account linked to a business under investigation. Suddenly, the story changes. What looked like separate events becomes one network. This is the moment financial crime becomes visible, not because one transaction suddenly reveals everything, but because thousands of small pieces finally form a recognizable picture. And once that picture exists, investigators can begin working backward. They can trace the money, identify the people, recover documents, question witnesses, freeze assets, and, when the evidence is strong enough, build a criminal case. The biggest myth about money laundering. People often imagine that successful money laundering means the criminal has permanently erased the money's history, but that's not really how the modern financial system works. Money doesn't forget. Banks keep records, governments keep records, companies keep records, property registries keep records, blockchain networks keep records, and even when information is hidden, it may not be gone. It may simply be difficult to access. That is a major difference, because difficult is not the same as impossible. A transaction made 10 years ago may suddenly become important when investigators discover a new connection today. A company that seemed irrelevant may become evidence after a whistleblower provides new information. A wallet that appeared anonymous may become identifiable after an exchange releases records. A property purchased years ago may become part of a criminal investigation when authorities discover who actually controlled it. The trail can remain dormant for years. And then suddenly, it comes alive. The real battle. The global fight against money laundering isn't really a battle between criminals and banks. It's a battle between complexity and visibility. Criminal networks try to create complexity. More companies, more countries, more transactions, more intermediaries, more layers. Investigators try to reverse that process. They simplify. They connect. They analyze. They follow the relationships. And slowly, the complicated structure begins to collapse into something much simpler. A person, a source of money, a network, and a motive. That's why the most sophisticated financial crime isn't necessarily defeated by finding one suspicious transaction. It's defeated by understanding the entire ecosystem around that transaction. Because dirty money has one unavoidable problem. Eventually, it has to interact with the real world. Someone has to own the property. Someone has to control the company. Someone has to authorize the transfer. Someone has to receive the benefit. And someone, somewhere, has to make a mistake. The longer the money moves, the more evidence it creates. The more evidence it creates, the more connections investigators can discover. And the more connections they discover, the harder it becomes to hide the truth. In the end, money laundering isn't really about making dirty money disappear. It's about trying to make its history invisible. And in a world where financial systems are becoming more connected every year, making that history disappear is becoming harder than ever.